Hey everyone, welcome back to Corporate Decoder, where today we're diving into NextCure Incorporated's latest filing, and let's just say it involves some serious financial maneuvers that will have investors talking. Get ready to unpack a private placement deal that could significantly reshape NextCure's financial landscape. We'll break down exactly what happened, why it matters, and what it might mean for the company's future cash flow. Before we get into the nitty-gritty, if you enjoy these deep dives into financial filings, do us a favor and hit that subscribe button. Also, we've got a fantastic community forming on Discord with the link in the description below. Come join the conversation there. So what we're looking at here is NextCure Incorporated making a big capital raise through a private placement. Think of it like an exclusive club for investors where a company sells a chunk of its stock and other securities. This happened on the 12th of November 2025. They brought in certain institutional and accredited investors who are essentially big players with deep pockets. The deal involves selling about 708,428 shares of their common stock directly to these investors. They also offered something called pre-funded warrants for an additional 1,815,049 shares. Now, a warrant is basically an option to buy stock at a certain price later. In this case, these pre-funded warrants are a bit unique. They let investors buy shares immediately at a very low, almost symbolic price of 1 cent per S-share, but they paid almost the full price for the share up front anyway. This is often a way to structure a deal so it looks more like a direct stock purchase for tax or accounting reasons, while still giving some flexibility. The total money raised before paying for the deal makers was about $21.5 million. That is a substantial amount, and it is crucial for a company like NextCure. This cash injection is likely aimed at fueling their operations, research and development, or whatever their strategic goals are for the near future. To put this deal together, they had H.C. Wainwright and Company acting as the go-between, the placement agent. They're the ones who found the buyers and helped negotiate the terms. Companies pay fees and expenses to these agents, which is why the net proceeds will be a bit less than the $21.5 million gross amount. Now, here is an interesting kicker as part of the deal. NextCure agreed not to issue or make any new agreements to issue more company stock or similar securities for about 30 days after a registration statement is approved by the SEC. This is a pretty standard clause to prevent diluting the value of the shares that were just sold in this private placement before they can be properly registered and potentially traded more widely. It creates a sort of quiet period. Alongside the purchase agreement, they also entered into a registration rights agreement. This is super important because these shares were sold in a private placement. They weren't registered with the Securities and Exchange Commission. That means they couldn't be easily resolved by the investors on public markets. The registration rights agreement basically obligates NextCure to file a registration statement with the SEC to allow these investors to eventually sell their shares publicly. It is a commitment to making these privately held securities public down the line, which is a critical step for these types of offerings. This part of the filing confirms that the equity securities they sold weren't registered under the Securities Act. They're relying on an exemption, specifically Section 4 at 2 and Rule 506 of Regulation D. This confirms the private nature of the placement and underscores the reliance on specific exemptions to avoid the full registration process, which can be lengthy and expensive. They basically told the CSE that the buyers were sophisticated enough to understand the risks involved in buying unregistered securities. Fast forward a few days to the 17th of November 2025, and NextCure put out a press release confirming that this private placement had officially closed. This is when the deal was finalized and the money officially changed hands. They confirmed the closing of the offering. And here is the strategic outlook that came out around the same time. NextCure announced that based on their current projections, they believe their existing cash, plus whatever they can easily turn into cash, will be enough to keep the lights on and fund their planned operations through the first half of 2027. This is a really key statement for any company, especially in the biotech or pharma space where R&D can be a cash burn. They're essentially saying they have a runway. Of course, they add the crucial caveat that these are estimates, assumptions that could be wrong, and they might run out of money sooner than expected. It is a carefully worded statement balancing optimism with a dose of reality. This is just an exhibit, essentially a template of the pre-funded warrants they issued. It lays out the precise terms and conditions under which these warrants can be exercised. This is the main document we've been talking about, the Securities Purchase Agreement, detailing all the terms of the private placement. And as we mentioned, this exhibit holds the full details of the agreement that obligates NextCure to register the shares for public resale by the investors. This is the actual press release they put out on the 17th of November, announcing the closing of their private placement offering. So let's tie this all together. NextCure Incorporated needed capital, and they secured about $21.5 million through a private placement of stock and warrants. This is a move to strengthen their balance sheet and fund future operations, aiming to give them enough breathing room until mid-2027. The key takeaway here is that while they've raised a significant amount of money, it came with specific conditions, including the commitment to register these shares later. This is a common strategy for companies needing quick access to capital, but it does mean future dilution when those shares eventually hit the market. Looking at this strategically, this private placement suggests that NextCure might be facing a situation where traditional debt financing is less favourable, or they simply prefer to raise equity. The fact that they're confident enough to project funding into mid-2027 is a positive sign about their operational planning. But the caveat about potential shorter runways is a classic reminder of the inherent risks in this industry. Investors should keep a close eye on that registration statement when it is filed, because that will signal when these new shares can become available for trading and potentially impact the stock price through increased supply. What is your take on NextCure's capital raise strategy? Do you think this funding runway is enough to see them through their next phase of development? Let us know your thoughts in the comments below. If you found this breakdown helpful, please hit that like button and subscribe for more deep dives into corporate filings. And don't forget to join our Discord community in the description for more in-depth discussions. Thanks for watching, and we'll see you in the next one.